So you want to be a millionaire. While there's nothing magical about having $1 million, being able to say that you are a millionaire has a nice ring to it. It gives you some bragging rights. And most importantly, it means you're doing fairly well financially speaking. So how do you get there? How do you go from being just an average Joe who's broke to becoming a millionaire? To do this, you might try to invent some new product, or maybe you're trying to reinvent the wheel and come up with a new process or a new system that revolutionizes an existing marketplace. But that's pretty tough to do. If only there was some sort of a tried and true method that's been proven to consistently work time after time. Almost like a blueprint to success. Well, thankfully there is such a blueprint. You see, there's one asset class that over mankind's history has generated more wealth than any other asset. You see, no other asset class has come anywhere close to generating as much wealth as real estate has. For centuries, only wealthy people were allowed to own land. And owning land often came with special privileges, such as special titles or nobility. In fact, the term landlord comes from some of these special titles of lords and ladies who owned land. And real estate is just as important today as it was hundreds of years ago. In fact, one recent study suggested that people who own their own homes have significantly more net worth than people who rent their homes. Homeowners on average have a net worth of around $231,000 according to this study, while renters have a net worth of a mere $5,000. That's a very significant difference. Besides owning your own home, many people own additional properties that they rent out to others each and every month and collect an income on those properties. So let's see how you can generate a significant amount of wealth using rental properties. Now, when it comes to real estate, there are 4 primary ways in which we are going to generate wealth. And the first way that we're going to do that is with cash flow. Now, cash flow is the amount of income that you have coming in after all of your expenses are paid. Unfortunately, cash flow is very difficult to calculate because while some expenses are set in stone, like your mortgage, your HOA, your property taxes, etc., some expenses are going to be hit or miss, and they're going to vary. And that's going to be difficult because there's going to be times when you're not going to have a renter in your unit. The unit is going to sit vacant while you look for a new tenant. Now, you're not always going to have to repaint or replace the carpet, but every once in a while, those things happen. You need to set aside additional money every month to budget for both the little expenses that pop up as well as the big expenses like fixing a roof. So when you're trying to calculate your estimated cash flow, be sure to budget for both the known and the unknown when it comes to expenses. That way, when you do have to replace your roof, you've already set aside enough money in your budget to be able to tackle that, and it's not a surprise. The second way that we're going to generate wealth with real estate is going to be with appreciation. I think I spelled that right. So appreciation is essentially your home increasing in value. Now, there was a very famous research study that was done on the topic of appreciation rates of houses. This is known as the Case-Shiller study, and it was so famous, in fact, that it won the Nobel Prize in economics. Now, essentially, what the outcome of this study said is that homes don't actually increase in value. Instead, they simply keep up with the overall rate of inflation. And that makes sense because if homes appreciated too much or too little, then over time, homes would either become significantly overpriced where nobody could afford to buy them, or they would become very, very cheap where everybody could buy them. The long-term inflation rates for the United States is currently sitting at about 3.22%. So if we can expect our homes to keep pace with inflation, then we could, over the long run, estimate that the value of our homes will increase on average by 3.22% per year. The third way that we can generate wealth with real estate is going to be loan paydown. Now, when you first buy a house, most people get a mortgage. They go to a bank and they get a loan. And then over the course of time, you slowly pay down that mortgage and that loan. So that loan that starts off pretty high starts to become a little bit less. And the longer that you pay down the note, eventually you own the property outright and you have paid down 100% of the loan. And the last way that we are going to generate wealth with real estate is with taxes. Real estate has some of the most tax-friendly laws out of any business in existence. Now, when it comes to taxes, we all know that the tax code is heavily skewed to favor some people as opposed to other people. But if you think about it, who has written the tax code? Wealthy individuals. For hundreds of years, wealthy businessmen have been writing the tax code. But remember, how did most of these people get wealthy in the first place? Well, if you go back and remember that all of these lords and ladies and people of nobility, they owned land. So it makes sense that there is hundreds of years worth of tax write-offs and benefits for landowners. So real estate is some of the most favorable tax advantage structures that you will ever find. Now let's take a quick example of purchasing an actual home. Let's say that you go out and you purchase a $200,000 home and you put down a 20% down payment. And so 20% of $200,000, that is a $40,000 down payment. And then you get a $160,000 loan. Now, maybe real estate in your particular area costs more or less than $200,000. That doesn't really matter. The numbers are going to be the same regardless if it's a $200,000 house or a $1 million house. It's all going to work out generally the same way. Now, remember that cash flow is difficult to calculate. But let's say that after we pay all of our expenses, our mortgage, HOA, property taxes, our estimated repairs, vacancy rates, once we pay all of that stuff, let's assume that our rental rates are $300 higher than what our expenses are, so that we are cash flowing $300 per month, which translates into $3,600 per year. If we go back and assume average appreciation rates of 3.22%, then after 1 year, our $200,000 home is not worth $200,000 anymore. It has now gone up in value to $206,440. Number 3, our loan paydown. Where we started with a $160,000 loan, we've been making monthly payments to that mortgage each and every month. And while the majority of that money goes to things like interest on that loan, some of it will go to the principal so that we're slowly paying down our mortgage. So after 1 year, now instead of owing $160,000, we owe roughly $157,900. Now in our example, taxes are going to be very difficult to calculate because everybody's tax situation is a little bit different. So we are going to omit taxes entirely for the sake of this argument. But just remember that real estate has some of the most tax-friendly benefits out of any sort of business that you could possibly engage with. So whatever numbers we come up with, it is going to be even better than that. All you need to know is we're going to make some money on taxes. So after 1 year, if we go and we try to sum up all of the different ways that our net worth has increased, we can just simply add them up. So our cash flow is going to be $3,600 for the year. Our appreciation, it has gone up in value by $6,440. And our loan has been paid down by roughly $2,100. So a little quick math says that our grand total that we have made in our first year is $13,140 worth of total net worth increase. That's going to be a 32.8% return on our initial investment of $40,000. Now, historically, the stock market has averaged roughly a 10% return on investment annually once you account for dividends. So if we're getting 32.8%, that is blowing the stock market clear out of the water. But that's just after 1 year. What if we were to expand this a little bit? And what if we were to calculate instead over a 10-year period? So over a 10-year period, we'll try to keep things nice and simple. We'll say that you never once raise the rents on your tenants, which is not going to happen. But for the sake of argument, if you were making $3,600 a year, then over the course of 10 years, you would make $36,000 in cash flow. And if we assume that we are still going to get that average appreciation rate of 3.22%, now our home, instead of being worth $200,000, is going to be worth $274,600. And our original loan that started off at $160,000 has been slowly paid down, and now the remaining balance on our loan is only $127,000. So as you can see, our home has gone up in value to almost $275,000, and our balance has been paid down to $127,000. So if you subtract these two, it is going to give you your equity. And in this case, we're going to have $147,600 in equity. Now, once you add in the $36,000 from cash flow, you're going to come up with $183,600 worth of net worth. So where we originally invested $40,000 as our down payment, that $40,000 has more than quadrupled and is now worth $183,000. That's an amazing return of investment in only 10 short years. And I can hear some of you guys at home saying, big deal, $183,000. You're still not a millionaire. And that's true, but consider these 2 points. Number one, we only ran this scenario out for 10 years. Imagine our gains at year 15, 20, or 30. And even more importantly, this is only by having one rental property. Imagine having 2, 3, or 10 rental units. So how do you get these additional units? Well, instead of simply spending this $36,000 in cash flow that we had gotten over the years, maybe we put that towards the down payment of our second house. And what if we refinanced our home, or we took out a home equity line of credit and accessed some of this $147,000 worth of equity and used that money to purchase a third or even a fourth home? This system creates a snowball effect where additional properties begin coming faster and faster and faster. As you are getting the cash flow appreciation and loan pay down, you can use that money to leverage and purchase additional properties. Now, this leveraging of properties and exponential growth, combined with our ridiculously high 32.8% return on our initial investment after that first year, these two factors are going to combine in extraordinary ways that is going to cause our net worth to quickly skyrocket. Now, some of you out there might have a few concerns, and usually the first concern is going to be, well, where do I get the money for that first down payment? And a lot of times people simply save money from their job for that first down payment. But you can get more creative than that. Maybe you want to do some house hacking for your first property. Or maybe you want to utilize the BRRRR method, which is buy, rehab, rent, refinance, and repeat. Or maybe you will bring on partners to help fund the deal, or private lenders. Maybe you want to do a fix and flip and use the profits generated by that flip to then reinvest into a long-term buy and hold rental property. The options are limitless. It's just a matter of going out there and starting the process. Number 2, how do you know if you actually have a good deal or not? Now, this is going to be very market dependent. You're going to find that real estate varies drastically from one side of the country to another. But what you're going to want to do is you're going to want to pick an area that you want to invest in. Usually the best place to invest in is whatever town that you're actually living in. It makes it so much easier to manage your properties. But even within inside of a town, you might have some neighborhoods that are significantly better off than others. So first, narrow down a very specific geographic location that you would like to invest in. And then just start doing some research. Pull up a list of homes that have recently sold and get the price data for what they sold for. And then compare that to the estimated rental values that these properties could receive. And by analyzing numerous properties and comparing this rent to sales price ratio, you're going to get a pretty good idea of what the average ratio inside of your little geographic neighborhood is going to be. And then when you find a property that has a significantly better ratio than what you have historically seen, that's when you know that you might want to dedicate a little bit of extra time and effort into looking at this one particular property. Number 3, how do you manage all of these rental units? You don't. I mean, you can, but I hire a professional management company to do all of that work for me. So they're going to be the ones that find the tenants, show the property, have them sign a lease. They handle collecting and distributing of the rent paychecks, collecting it from the tenant and then distributing it to me. And they're the ones that handle all of the maintenance requests. So when a toilet suddenly starts not working at midnight, the tenant is going to be calling them instead of me. Now, obviously, this does come with an additional cost, but I simply factor that cost into my monthly cash flow factor. And lastly, what if the market drops? Well, the market could drop with any asset class. Sometimes by a little bit, sometimes by a lot. Events like 2008 do happen. But thankfully, historically, real estate has a pretty normal trend line. In fact, if you look at historical data, the majority of the recessions that the United States has gone through, housing prices have either stayed flat or have actually gone up in value. It's relatively rare that home prices drop, especially by any significant mean. But if the market does drop, then that's fantastic. That's a good time for us to go out and try to buy additional properties at this discounted price. This is when we want to try to expand our business and take advantage of those cheap prices. Now, the good news is that since your properties are already cash flowing, there's no need to panic and suddenly sell your properties. There's never going to be a situation where you are so desperate where you need to sell your properties since they are already paying for themselves and cash flowing. So if the market does suddenly drop in value, just hold on to your properties. Don't sell them. Just be happy to collect your monthly cash flow each and every month and wait it out and wait for the market to return back to normal and for those prices to go back up. Now look, becoming a millionaire in real estate is not going to happen overnight, but it will happen as long as you are patient and diligent with your investing. You stick to sound investing principles and continue to educate yourself so that, in theory, each consecutive deal that you do is slightly better than the one that you did previously. Now, obviously, individual results will vary, but the majority of people that I know that have become millionaires in real estate have done so in somewhere between 5 and 15 years. So what are you waiting for? Get out there and start looking at some properties.